Hello, my name is David Buckland and welcome to this week's Video Insight. Today I'm going to discuss the need to consider the balance sheet effects of debt-induced growth, with a specific focus on China. In 2018, the Shanghai Composite Index was one of the worst performing stock markets in the world, down 25% to under 2,500 points, and in fact down 60% from its all-time high back in October 2007. Last year's decline coincided with a level of Chinese bond defaults exploding to over $23 billion as the central government started to allow corporates, local government finance vehicles and even state-owned entities to default on their debt. In February this year, two large Chinese corporates again missed bond payments. Established in 2014, China Mingxing Investment Group is a private company which has developed into a sprawling conglomerate owing around $35 billion. The majority of this is set to mature later this year, and repayment is uncertain, and it's exacerbated by the fact that some assets earmarked for sale have been frozen by Shanghai's financial court. The second company, Windtime Energy, is a repeat offender, being the second largest bond defaulter in 2018. More recently, China has been seeking to limit the fallout of its deleveraging program by adding a record amount of cash to the financial system, pumping the bubble again. The stimulus is thought to be worth about $700 billion, or equivalent of about half of Australia's GDP. The magnitude of this stimulus, illustrated here, has delayed the onset of any credit meltdown, and the share market has responded by jumping about 21% so far this year to over 3,000 points and retracing about two-thirds of last year's decline. Despite this, investors must be mindful that, one, many Chinese investors had come to expect their debt investments were riskless after a long history of government bailouts. But when investors start to take losses, they respond by going down the yield curve and restricting their investments. Two, the upward trend of Chinese bond defaults is likely to continue as the more speculative corporates just don't generate enough operating profit to cover their interest expense. Three, the yield spread on that junk paper over the top-rated debt has doubled to 3% over the past year. And four, China accounts for around a third of the world's economic growth. At the same time, it accounts for 60% of the world's credit growth. As Chinese businesses and consumers face difficulty in accessing new debt, their propensity to invest and consume is declining. Thanks for watching, and don't forget to follow us on Facebook and Twitter.